The stock market looks strong on the surface, but under the hood, two metrics are flashing warning signs. In this video, I'm going to break down what these two metrics are, why they matter, and what this could mean for your portfolio. We're going to dive right in. Are we about to see a stock market crash? Let's take a look at the Schiller PE ratio. So the Schiller PE ratio compares the stock market's current price to the average company's profits over the past 10 years. And this tells us if stocks are expensive or cheap. So in this case, the profits we're measuring are profits of the companies in the S&P 500. So right now at 39 times, it's saying people are paying $39 for each $1 of earnings the combined companies generate. Now, what does this look like? So this Schiller PE ratio chart, it goes back to like before the 1880s. And right now, we're at 39 times. This is the point we're at today. And the last time it was about this high, it was higher during the tech bubble. And the highest it's ever been was around 44 times in December of 1999. The lowest, just under 5, and that was in 1920. The average has been around 17 times, the median 16 times. We are at more than double, at 39 times. So remember, the last time it was around this high was the tech bubble. Now, what happened the 3 years leading up to the tech bubble? The S&P 500 returns, including the dividends, in 1997, 33% return, 1998, 28%, 1999, about 21%. Looking familiar? And now what happened after? So the bubble popped. In 2000, the markets dropped about 9%, and then it dropped another 12%, and then another 22%. So just an FYI, the S&P 500 returns over the last 3 years, so in 2023, 26%, 2024, 25%, and year to date, 2025 this year, around 11%. Another number we want to look at is the margin debt. So what is margin debt? Margin debt is the money investors borrow from brokers to buy stocks. Think of it as leverage. It lets people control more stock than the cash they actually have. So this allows them to amplify their gains, but on the other end, it also amplifies their losses. So margin debt hit a record $1.02 trillion in July. We're at this point. See this purple line right here? This is the level of margin debt. And again, it was higher in 2021. And what happened? The stock markets corrected. And as you can see, if we go back to 2000, it hit this level and then markets corrected. In 2007, the Great Recession, margin debt hit this level and then the markets corrected. And same thing over here, 2021, and now we're at this point. The monthly margin debt increase of $87 billion in June, that was the largest monthly increase in history. Okay, people are borrowing money like crazy. The last 2 years, margin debt exploded. It added $400 billion of debt. That's a 67% increase. That outpaced the growth of the market itself. And as a percentage of GDP, margin debt has surpassed every previous peak except 2021. And here it is, this point right here, it is higher than every previous peak before the tech bubble, before the Great Recession, except in 2021. So why does this matter? Well, excess leverage. These numbers suggest investors are piling into stocks using borrowed money at an unprecedented pace. This isn't just regular investing, it's speculation on steroids. This increases market vulnerability. When leverage is this high, even a small market downturn can trigger margin calls. And this is when brokers are forcing investors to cover their losses because brokers like, we want our money back. That's going to accelerate even more sell-offs. And the fact that margin debt is growing faster than the market itself suggests people aren't just investing their own money for long-term growth. They're chasing quick gains. They're leveraging because they want to amplify their returns. This is indicative of speculative behavior. So what does this mean for you? Should we be expecting a crash soon next year? This run could go on for another year or 2 or 3. I don't know. What we can do is control our own actions. That means if you're still decades away from retirement and you have a long time horizon before you need to tap into your investments, you know the drill. You are either going to one, do nothing. Two, if you have a pile of cash, in the event of a market crash, you can load up on your investments. Think of it as a sale. Or you are going to continue investing as you are. Maybe you have auto payments set on, auto investments set on. This is dollar cost averaging every month. Now, as someone who manages and advises retirees, we can't help but become more defensive because these are larger portfolios at stake and people's retirement savings. They're likely depending on this cash flow to fund their lifestyle. And because of how stocks have been, people's portfolios have drifted away from their targeted asset allocation. For example, if you had a targeted asset allocation of 60% stocks and 40% fixed income, and now it's closer to 75% stocks and 25% fixed income, this is where rebalancing comes into play. That means trimming some stock positions, taking some profit, and shifting it over towards fixed income products, bond funds, bond ETFs, structured notes. You want to lower your exposure to equities. Remember, someone who is 30 years old is not going to have the same time horizon and risk tolerance as someone who is 65 years old. Asset allocation matters, and hence why it's even more important for those who are nearing or in retirement with a large portfolio to be diversified. If you enjoyed this video, please hit the like and subscribe button for more content like this.